Michael Klarfeld is a portfolio manager at ClearBridge Investments. Michael, it's great to have you here today. How attractive do you think dividend names will be going into next year?
Yeah, I think broadly speaking, in an inflationary environment, dividend stocks can be a great place to look for income because they're able to grow their income and their cash flows over time in line with inflation. And you contrast that with fixed income where, obviously your yields don't go up over time. So as inflation's eating away at your purchasing power, we like the ability of equities and dividend equities to be able to pass on some of their growing earnings and growing dividends.
And you have some familiar kind of blue chip names here. Who are your favorites?
Yeah, so I think there's a lot of opportunities. I think as we think about how to position for inflation, there's kind of two things we're thinking of. What do we want to own, and then what do we want to kind of avoid or reduce our exposure to? And I think as we think about a more inflationary environment, we want exposure to banks and energy. Banks, we expect in an inflationary environment that interest rates will rise and that'll drive higher earnings growth for banks. On the energy side or the commodity side, we see energy prices being up a lot. We think that's going to stay at least for the reasonable foreseeable future, which should drive solid earnings growth at energy companies. So we think those are good places to be. The other part, which you mentioned earlier, is just that we're looking for more broadly is pricing power. So we look a lot across the sectors and across our portfolio, looking for companies with the ability, as their costs are going up, to raise their prices to their end consumers so they can maintain their profitability. On the side of stuff that we're trying to avoid a little bit or reduce exposure to, as we shift into this inflationary environment, we're coming out of a period where growth stocks have done very, very well. And they've done very well for a couple of reasons. First off, they've delivered fundamentally, right? The financial performance is great, strong revenue, strong earnings growth. And so their stocks deserve to be rewarded. But their multiples have also been flattered by very low interest rates. So we do worry that if interest rates were to rise significantly, you could see multiple pressure on some of these higher growth stocks, which may make investors want to consider their exposure there.
And now we're back to the old where will interest rates go argument, Michael. I mean, obviously they haven't risen the way people have expected them to for the past 1, 2, maybe 5, 10, 15, and 20 years. So for those, look, dividend yield is still attractive. I don't think anybody would turn it away. But what would you say to those who are more dovish on rates?
Yeah, so listen, I think you're exactly right. People have been talking about the potential for rising rates for some time, and it hasn't happened. So it's sort of the boy who's cried wolf. At the same time, I'd make two observations. One is it certainly does seem like we're in a different environment now. We are seeing real changes in costs around the economy. And so that does seem to be different. The second thing I'd say is, though, it's important when you're looking for investments and thinking about positioning for rising rates, where there's sort of an option to benefit from rising rates, but where it's not predicated on just that or just predicated on inflation. So some of the names that we like a company called Williams in the energy space, which is a natural gas pipeline company. It's the largest pure play natural gas pipeline company. It pays a 6% dividend today, so very attractive upfront yield. And with what we're seeing in the energy markets, we expect very strong growth in natural gas. So you're getting a 6% yield, which we think will grow nicely over time. And we think that natural gas plays a really big role in the energy transition going forward. So both from a fundamental perspective and an ESG perspective, we think natural gas is a good place to be. Fundamentally, we expect a lot of growth in natural gas, as increasing natural gas is required to actually replace coal and some other sort of worse committers or worse sinners in the energy space. So that'll drive a lot of fundamental growth. And then from an ESG perspective, we actually think that gas can be a good guy because it really does help to displace some parts of the supply curve for energy, like coal, like oil, which are contributors.
Absolutely. I think we're all learning more than ever about, the characteristics of each of these. Michael, thanks for your time today. We appreciate it. Michael Klarfeld.
Pleasure. Thank you.